Hello and welcome. This discussion is brought to you by the team at My Tax Accountant. Now, let me ask you something. Are you thinking about gifting your home or maybe your business to your family? It's a wonderful thought, right? But what if I told you that gesture could hide a really nasty surprise, a massive tax trap? Well, today we're going to drag that trap out into the light and show you exactly how to avoid it. Let's get into it.
I know, it sounds a bit dramatic, doesn't it? But honestly, this is a very real question for so many families across the UK. You've worked your entire life to build something valuable, and of course you want to pass it on. But one simple, well-meaning mistake in how you gift it could land your kids with a tax bill that is just eye-watering. We're talking tens, sometimes even hundreds of thousands of pounds.
So what we're going to do today is unpack one of the most confusing but absolutely critical parts of UK tax law. It's called the Gift with Reservation Rule, or GWR for short. And the whole reason it exists is pretty simple, actually. HMRC just wants to make sure people aren't pretending to give away assets just to dodge inheritance tax while they're still secretly enjoying them. So if you own a home or a business, you really need to get your head around this. It's the key to making sure your generosity actually helps your family instead of hurting them.
So, here's our roadmap for today. We'll kick things off by explaining what this hidden tax bill actually is. Then we'll dive into a couple of real-life stories, one about a homeowner, one about a business owner, to see the damage it can cause. Then we get to the good stuff, how to fix it. We'll cover gifting the right way, look at some expert rules and exemptions, and then wrap it all up with your very own GWR action plan.
All right, first things first, let's get right to the heart of it. What on earth is a gift with reservation, and why is it such a massive deal?
Okay, so here's the official jargon from the Finance Act 1986. But let's put that in plain English. A GWR is basically when you give something away, but not really. You've still got strings attached. Think of it like this. You give your mate a brand new car, but you tell them you still need to use it for your commute every single day. Have you really given it away? Not completely. And that's exactly how HMRC sees it. They'll just say, nope, sorry, for tax purposes, that's still your car. And listen up, because this is the bit that trips everybody up. You've probably heard of the 7-year rule, right? The idea that if you make a gift and then live for another 7 years, it's totally free from inheritance tax. Well, with a GWR, you can just throw that rule straight out the window. It doesn't apply. Why? Because in HMRC's eyes, the 7-year countdown never even started. If you're still getting a benefit, the gift was never truly made, so it doesn't matter if you live another 7, 17, or 27 years. That asset is stuck in your estate.
And here's the number that should make you sit up and pay attention. 40%. That's the standard rate for inheritance tax in the UK for the 2025/26 tax year. A gift with reservation can pull an asset you thought was safe right back into the firing line, and that means a massive 40% chunk could be taken out of its value. That is a devastating bill for your family to face.
Okay, enough with the theory. Tax rules can be pretty dry, so let's make this real. Let's talk about a homeowner we'll call Doreen, who got herself into a situation that is, unfortunately, incredibly common.
Doreen's story is one we hear versions of all the time. She's retired, her house is her nest egg, and she wants to give her son Nigel a head start by transferring the house to him. To make things easy, she just carries on living there exactly as before, not paying any rent. She thinks it's a simple, loving family arrangement. But what she doesn't know is that she's just walked straight into a tax nightmare.
And this table right here shows you the brutal financial cost. Just look at the difference. If Doreen had made a clean gift, what's called a potentially exempt transfer, and lived for 7 years, that $500,000 house would have cost zero in tax, nothing. But because she stayed there rent-free, it's a GWR, the full $500,000 gets pulled back into her estate. After a tax-free allowance of $325,000, her son Nigel gets hit with a tax bill for £70,000. A $70,000 bill that was completely 100% avoidable.
Now, you might be sitting there thinking, okay, that's for homeowners, but I own a business. Well, I've got news for you. The GWR rules can be just as brutal, if not more so, for business owners.
So let's meet Rajesh. He's built a fantastic family business from the ground up, and he's ready to pass it to his daughter, Priya. So he transfers all the shares to her name, but he makes an arrangement to keep receiving the dividend payments himself. It seems sensible, right? A way to fund his retirement. Just like Doreen, his heart is in the right place. But by keeping that income stream, he has reserved a benefit, and that is a textbook gift with reservation.
And here is where it gets incredibly dangerous for people like Rajesh. You see, many family businesses qualify for this amazing thing called Business Property Relief, or BPR. It's basically a golden ticket from the government that often lets you pass on a business with a 100% tax discount, meaning zero inheritance tax. It's incredible. But a GWR can take that golden ticket and just rip it to shreds. HMRC can deny the relief entirely, and just like that, a 100% tax-free gift turns into a full-blown 40% tax catastrophe.
Okay, that's enough of the scary stuff. The great news, and I mean really great news, is that all of these traps are avoidable. You just need to know the rules of the game. So, let's talk about the solutions.
It really boils down to 3 golden rules. Number 1, if you're going to keep using the asset, like Doreen in her house, you have to pay the proper going rate for it, the full market rent. Number 2, and sometimes this is the cleanest way, just seesaw benefit. Make a clean break. And number 3, whatever path you choose, document everything. I mean everything. Think of your paperwork as your armor. It's what will protect you if HMRC ever comes knocking.
And here's a pro tip on that first point. When we say pay market rent, we don't mean just giving your son or daughter a bit of cash now and then. This needs to be buttoned up and formal. We're talking a proper tenancy agreement, rent that's been checked against local rates to make sure it's correct, and a clear bank record of regular payments. You should even review the rent every year or so just to make sure it stays in line with the market.
And hey, did you know this? Sometimes solving one tax issue can create a whole new one. Let's go back to Doreen and Nigel. If she starts paying him rent, guess what? That rent is now Nigel's income. And he's going to have to pay income tax on it. This just shows you that tax planning isn't about looking at one problem in isolation. You have to see the whole board.
All right, so we've covered the main rules, but now we're going to get into the nitty-gritty, because the law is full of little nuances and exemptions, and frankly, this is where having an expert on your side can make all the difference.
Now, believe it or not, HMRC does have a bit of common sense. The rules allow for what they call insignificant use. So, if you've gifted your house, you can still go and stay for a couple of weeks a year to visit. You can pop over to babysit the grandkids. If you gifted a car, you can still get the odd lift. It's all about what's reasonable. As long as it's not a regular, predictable benefit, you're usually okay.
And here's a really clever one for you, a more advanced strategy. It's called the shared occupation exemption. This is where you don't gift your whole house, but a share of it, and the new owner, say your child, actually moves in and lives there with you. If you're both sharing the house and the bills, HMRC will often agree that it's not a GWR. But the key word here is genuinely. It has to be their real home.
Just when you thought you had it all figured out, there's a cousin to the GWR you need to know about. It's called the Pre-Owned Asset Tax, or PAT. The big difference is this. GWR is an inheritance tax problem that hits your family after you're gone. PAT is different. It's an income tax charge that you personally have to pay every single year that you're benefiting from the asset. It's yet another reason why getting the structure of your gift right from day one is absolutely crucial.
Phew! We have covered a lot of ground. We've seen the problem, we've looked at the consequences, and we've explored the solutions. So let's bring it all together now with a clear, simple action plan to help you secure your legacy.
Okay, here's your checklist. First, I want you to have a think. Look back at any big gifts you've made. Are there any hidden strings attached? Second, from now on, for any new gift, document everything. Third, if you're still using an asset you've gifted, get that formal market rent agreement in place. Fourth, don't forget those clever exemptions we talked about. And finally, and this is by far the most important takeaway, please seek professional advice before you act, not after the damage is done.
Look, estate planning can feel like you're trying to navigate a minefield blindfolded, but you absolutely do not have to do it alone. The right advice can help you protect your assets and secure your family's future, so don't leave it to chance. Get in touch with the experts at My Tax Accountant. You can reach them on WhatsApp or give them a call on 07854 25 375. You can also drop them an email at info@mytaxaccountant.co.uk. And for more brilliant insights like this, make sure you subscribe to their YouTube channel. Thanks so much for joining me today.